okay, record. And we'll do show my desktop. I'm going to be I'm doing what I've done in the last few weeks. I'm using two different showing my desktop on my desktop, and using my microphone on my laptop to improve the sound quality, the bandwidth quality. It seems to have been working. Okay. Let us first I'll do some cool announcements about just program announcements. We're working on a lot of exciting projects here that keep me up, certainly in the office till past midnight every night. From our various publications that we're constantly working on, like, by example, Tax Havens of the World. I'm sure everybody in the offshore world is familiar with Walter Diamond's Tax Havens of the World. So we're working on that, Foreign Tax and Trade Briefs, International Trust Laws by Walters Kluwer. We have 4 significant treatises that we're working on all the time, constantly updating and so forth. In fact, Rosanna, who's in the class now from Brazil, worked on a book by Oxford University Press on e-commerce that we hope to put out, which will be published early next year. A new cool project we're working on is evolving the way that publishing works and using issue and mind mapping technologies that aren't used yet in the public sphere. They're only in development stage at universities. We're going to be applying this. I'm going to send out a cool link via the career services, where everybody in the class has an email address, the new career services class, and you'll see some examples of concept that we're playing with. It's pretty cool stuff. And I'm being interviewed by Chief Learning Officer magazine this week about it, and they have their big conference in San Diego this week. CLOmedia.com. The other cool announcements: career services tomorrow, Wednesday morning, for the anti-money laundering class. We have Jason Simpson presenting. Jason has moved, he's an alumni, and he's moved up in the ranks, and he's now employing 10 to 15 people. In the next 2 weeks, he's going to finish up his team, and those jobs have been made available via Facebook. And we've emailed through Facebook, and we've put the actual job posting in Facebook under the discussion forums. So 10 to 15 anti-money laundering compliance jobs in 10 to 15 anti-money laundering compliance jobs in Miami for Standard Chartered, formerly known as American Express International Bank. And so those are pretty good, interesting positions being made available by an alumni. So tomorrow he's going to be talking about the state of the anti-money laundering compliance industry, and it's going to get more interesting because the investment banks, which many people said were under a lighter regime because the SEC wasn't so rigorous on the money laundering aspects of things, now fall under the what people say is a very rigorous, perhaps too rigorous, the bankers say, regime of the Fed, of the OCC, and so forth. And of course the application of the FFIEC manual. So you have some rather large operations being pulled under these regulatory regimes. So that's tomorrow, and I hope that everyone comes to listen to his talk, and also to hear more about the types of positions not only that they're hiring for right now, but that he sees being hired in the industry because they generally talk at that level. In fact, it'll be particularly, I think, interesting for Renee because you're doing or formerly doing compliance at HSBC. Okay, we've given enough time. We're going to start the lecture. Let's refresh our memories of where we've gone in the last 2 weeks while I pull up to save bandwidth. I'm going to make everyone's little no image available go away, and video layout. And that's me, so I need to keep that screen on. And this is desktop, so I'll keep this screen on, and we'll hit the word apply. Okay. So I'm going to swap these cameras, and we're going to. I'm going to open up a proxy server screen because we're going to be looking at the OECD model. Since this is officially the tax treaties course, but I want everyone from international tax to be attending it because the issues overlap. So, where did we go the last 2 weeks? 1 week ago, we covered the research databases, and we examined tax analysts, we examined IBFD and the cases available under both of those, and we examined CCH from a point of view of finding our treaties, whether they be the model treaties or treaty news. So we said tax analysts by far has the most friendly, user-friendly treaty news service. IBFD had the most robust case researching, and CCH had the most robust treatise material explaining the treaties. So each type of database had a different functionality that had advantages, and but then they had the disadvantages of not having the great news service if it was CCH on the treaties, but or the IBFD. It's still not the most user-friendly work like the tax analyst, just so user-friendly. But neither of those two have the robust treatise strength of CCH, but CCH is by far the least user-friendly of the three. For purposes of this course, you have your Klaus-Vogel book under the CCH. Okay. Then we did the same thing for international tax, and we looked at where we could find laws, and we looked at BNA, we looked at IBFD, we looked at Checkpoint, and we followed up on CCH. And so we're looking at where to find local domestic laws. And for those of you in Thesis 1, you'll be dealing with finding articles and having a more robust research capability on finding articles and so forth in the context of your thesis, but it'll also benefit you in the context of your research for both treaties and international taxation. Okay, last week. To summarize last week, double taxation is bad. World trade is good. That's the accepted paradigm of our global economy. So we looked at some examples of an Acme company that was investing, an educational company investing in its local jurisdiction, and that was X. And then to invest outside of its local jurisdiction, you'd have to modify X by risk factor. And thus, in modification by the risk factor R, X must be a greater return for that outward investment to occur than, so it must be X plus something to alleviate the risk, and just at a basic level. And then on top of that, and so the taxation took the form of a potential double taxation from a corporate income tax being applied in that example, and double taxation from withholding tax. In the Thursday lecture, we looked at in the international tax lecture, we looked at the double taxation also from the perspective of, and we opened up the textbook, and we said, well, what is tax in general? So sometimes double taxation occurs because what one country calls a tax, another country calls a fee. And we looked at the Brazilian example on a technical charge for royalties, and we looked at the American armor packing case, and then we looked at the list of potential taxes from Social Security, wealth taxes, and we went through a whole list of possible taxes, capital taxes, and so forth. And some countries have them, some countries don't. Some call it inheritance tax, some call it estate tax. Some call it gift tax, some call it transfer tax. Some have customs duty, some have excise, and so on. That summarizes last week. What I said this week is now we're going to look at the solutions. So that brings me to opening up a proxy screen. So I'm popping open my database page. I'm going to go to Research Databases. On my research databases, I'm clicking on Tax, International Tax. I'm just waiting for this to appear on my student screen because I don't see it appearing there yet. Hold on, I show my desktop turned off. That's why it's not appearing. One moment. So I need to hit start again. Right there. Yeah. Now, why is that? So I'm using the different screen. I get it. Okay. So, I'm popping open, again, my proxy server, and what we're going to do today is examine the architecture, the structure of the OECD as it impacts certain classifications of income, characterizations of income. And these are going to these are the solutions that the international geopolitical community has come together via the OECD or UN and decided for the alleviation of double taxation. On your screen in a moment, you'll see the proxy server. So once again, I went to my Easy Proxy. From Easy Proxy, I chose Tax International Tax, and from Tax International Tax, why for the? Hold on, I gotta see the message. Make this bigger. We couldn't access. I don't know, but I'll type in, if you can't access proxy server, we can access it here, help at tjsl.edu. Susanna says she's on it. Mark LaRue says he's on it, so it must be working. But if it doesn't, if you have problems with it, you'll need to contact the help desk at help at tjsl.edu. Having said that, maybe I remember last night I was trying to access it around 11:15 at night, and I noticed the lectures were down because I think they were uploading a massive amount of lectures from the day here. Mark says it took a few login attempts. It might have been that they were uploading all these lectures. I could get on either. So email help at tjsl.edu if you have proxy server issues. So here on tax, international tax, I'm going to go to the most user-friendly for me, and that is taxanalysts.com to look at the OECD model. However, something I encourage everybody to do before I go there, I'll pop into CCH, and I want to make 2 example announcements. 1, everyone should note that we have the second CCH. I'm going to make this announcement for a few weeks just to make sure everyone's on the same page here. The second CCH is where we have the new compliance materials. And so Renee, you were asking about the Checkpoint, by example, and yeah, Checkpoint and the new Checkpoint stuff, International Tax Expert and the new Internet Checkpoint. Well, remember that CCH has a competing product line that we also get for y'all, and it's under the top research bar. Anyway, you'll see the username and password there. You still have to come in through the proxy server. The Checkpoint one, I'll follow up the library today. Unless it's up here, I don't see it. No, I don't see it up here yet. So I'll follow up the library today and have those passwords put up for the second one. Okay. So from CCH point of view, for purposes of tax treaties, we're going to go into normal CCH. And normal CCH, I'll open in my new window. I'm going to go ahead and enter it. And what I'm going to put out is that everybody should, I have to enter. Remember, no, I have to enter directly on the database. Okay. 1 second. I have to check my. I was going into the other CCH, so I may have mistyped my passwords. Yeah. Okay. Yeah, okay. So here we are under CCH, and I am clicking on the top bar, International Tax, circling that in red. Everyone sees where I am. It's just showing up on my student screen now. So I'm clicking on the top bar, International Tax, and under the Treaties and Analysis section, Klaus Vogel. So I'd like everybody should read the introductory comments, and I'll circle that in red just to make sure. If you're not in the tax treaties class and you want to purchase the materials from IBLS, go ahead, but I'll give you other assigned readings also, like right now, that will put you in a similar position. And so I'd like everybody to read the introductory comments as well as the scope section. That's what we're going to be talking about today. Okay. I'm just pointing this out. Now, I'm scrolling down to Tax Analyst, back in my proxy server. Tax Analyst is popping up on my screen. It's going to pop up on your screen in a moment. I'm going to click on Worldwide Tax Treaties on the left-hand menu. So I click on Worldwide Tax Treaties, and I'm going to choose the Model Convention. The Model Conventions are going to pop open, and we're going to be looking at the OECD Model Convention on income and on capital condensed version. I'm going to want to pull open the articles, so I click on Model Tax Convention on Income and Capital again, and I get all the articles scrolling down the screen. You'll see this on your screen in a moment. Okay, we're now looking at the architecture of the OECD model. For those of you that have bought your books from IBLS, you should have found a collection of materials that were Module 4, Chapter 4, describing the architecture and the way the OECD model is put together. So I'm going to describe it in the context of our examination last week of Acme Company and its decision for cross-border investment between A and B. Now, in this course, we're going to cover most of the articles, if not all the articles, as you'll see from your syllabus, your course syllabus. In our discussion last week, we had our country A and we had our country B. And we had our Acme company, which was the A company. And we're simplifying things. In our little closed universe, we only have country A and country B. So Acme, our little square, has set up an office in country B. And Acme the office consists of, we'll say, 2 Acme directors. So 2D, my 2 directors who are living in country B for the next 3 years. One of them traveling back and forward between country A and country B every other month, and the other director being there permanently. And Acme has made an investment in an education company in country B, and we'll call that Beta. So it's made an investment in Beta. The investment is in 2 forms. Beta was a struggling company, you see, and Acme invested in 3 different methods as part of this agreement investment. 1, Acme bought a 10% share in Beta directly. It owns 10% of Beta shares, and it bought them from a retiring director who wanted to take some money off the table of Beta, and he's gone. Acme has warrants, and Acme has debt to Beta. This warrants and debt do the following. It's a $10 million debt, okay, that produces 10% interest per year, $1 million. At the end of 5 years, everyone catching this? So at the end of 5 years, Acme has a choice to convert this loan into equity at an agreed valuation amount so that Acme will be the owner of 51% of Beta. Or Acme can get repayment of its $10 million loan at the end of 5 years. It has a choice. And what are some commercial reasons that Acme would do this? Well, one, maybe Beta doesn't want to sell itself out now. Two, maybe Acme doesn't want the risk of owning Beta at this time for a variety of internal reasons or external factors. Three, maybe Acme wants the guaranteed $1 million of interest a year return as opposed to a risk-based return on equity participating in the earnings and profits. Now, Beta has customer access, that's distribution in the local B market, as well as some expertise for some materials. We're still using the education company because I forget who did it, not Susan Trachta. One of the students last week said we should talk about education companies. It's not because I'm here at university. It was Robin Savage. That's right, Robin. Okay, so everyone gets this scenario. This scenario allows us to hit a lot of the areas of the tax treaty. Now, referring back to last week, if there was no such thing as the alleviation of double taxation, this investment would never be made because the rate of return would have to be so high. Let's assume that our risk level is the lowest possible, that A and B are like America, Canada, and so they have a very similar internal risk factor. And one of the largest factors, of course, is market penetration, market share acquisition. Forgetting government expropriation, government regulatory, increase of taxation, all that kind of stuff, putting that off the table. And we said last week that in addressing those, they're addressed in the International Tax Planning Summer Course, and they're addressed with bilateral investment treaties, BITs, BITs, we address that in the summer, and that's addressed by, in fact, we have the world's leading BIT expert here on campus. He's been a professor here for, I don't know, a long time, 15, 20 years something, Ken Vandevelde. Okay, let's assume that all that's off the table. The only risk we're concerned about is market share penetration against the local people. And Acme is helping to alleviate that risk through investment by purchasing distribution in Beta. However, if double taxation then is our big concern and there was no relief for double taxation, the problem would be that the actual rate of return for Acme from going outside of its border, this is a closed universe of just A and B, the hyper rate of return for country B would have to be so high to alleviate and I think last week we had examples of taxation at 35% in each country, or I think there's 35% taxation in A, and let's say that country B is only 30% corporate taxation. And we said there was a 25% withhold on transfers from B to A, whether they're dividends, royalties, interest. We're going to say 25% on everything. make it easy for us to remember and calculate. So in this scenario of 100 profits being returned from B to A, first you take the 30 out, and now you get 70. And so if I took a I'm just going to put 100 above my 30, and that would leave 70. And then that 70, whether it's interest or dividends returning to Acme from Beta, then that 70, you take 25% of 70, and so what's that? 14 plus 3.5, so it's 17.5. So then, so that leaves what? 53? No, 52.5, or is it 62? 53, 52.5. Okay. And that same 100 without double tax relief in country A would be worth 65. And so 65 is a better return, especially considering that there is some risk element of 52.5. So now comes into play the OECD. So what is the OECD? Everyone's read either in Thesis 1 because you've already been in the class, or you're studying out about the Organization for Economic Cooperation and Development. This is the UN of trading countries. And where before it was only seen as the rich countries club, in the last 10 years, 15 years, it's opened up to include Mexico, South Korea, which is a rich country relative to UN standards, very wealthy. But it has observer status for India, China, Russia, Brazil. These countries, although they're not officially members, they certainly are at the table for discussion purposes, because the OECD seeks to, at least in theory, it's not supposed to be a diplomatic propaganda arm, as some people might consider the IMF or World Bank. It's truly supposed to be an organization that works out the big issues. In the case of tax treaties, tax treaties, it's working out double taxation problems. And I know there's some people, obviously, in the international financial centers world industry that say, well, the OECD is a propaganda arm, and fair enough. That's a different discussion for that class, offshore financial centers. But just for purposes of A and B, which are very similarly situated from a tax point of view, the OECD is seeking to work out problems. So they come to the table, the negotiators, the ministries of finance and the Treasury, the Revenue Department officials come to the table to work out how the relationship of taxing rights between country A and country B should develop, should be how country A and country B should either levy or not levy tax on different types of income, so that the net effect is that a party in country A chooses or has the opportunity to invest outside of its borders in country B, a country with which it has a double tax agreement based on the OECD model, so that it chooses to invest in country B under the same circumstances, the same taxation circumstances it would choose to invest in its own country, so that it's not in a discriminatory position, or at least that any excessive tax above somebody in country B who is a domestic investor has been mitigated pursuant to this agreement between country A and country B. I know what I just said is very theoretical, so I'm going to bring it down to some down to earth, ground it, and we'll ground it with the first example of Acme has an office with 2 directors. So I'm only going to talk about my top portion of my little picture right now. Acme has an office with 2 directors. Now, A and B, their Revenue Department officials or their State Department officials or a combination thereof, we'll get to treaty negotiations much later in the class into the syllabus. Marshall Langer will be talking about that and how it works in practice. And we'll be joined by the government of the Seychelles and the government of Kenya and Tanzania, and we have IRS people will be joining us to bring about that discussion from a geopolitical government point of view. We'll even run a negotiation case study. But for purposes of our little theoretical talk, we get our government officials sitting around a table, and you get A, and A represents Acme. It doesn't really represent Acme. A represents the people, the economy of country A. And B represents the people, the economy of country B, and its taxing authority. Absent the tax treaty, B simply levies tax pursuant to its normal domestic rules. Now, some countries in the past, it's not so common anymore, but it still does exist. Some countries don't even want to encourage, they want to discourage foreign investment, but they would levy different rates of tax. Like locals get 0 rate and foreigners get 25% rate of tax. Well, that discourages all foreign investment. Foreigners, that's just not commonplace anymore. So that's not really a discussion. However, that discussion is still relevant in the context of withholding taxes. It's not that discussion is evaporated, because when we see Beta returning money to Acme, there's a 25% withholding tax. Now just imagine for a moment that B was like the United States and it had a withholding tax on branch profits that were distributed back to the head office. Acme is the head office, my HO, my head office. And my little circle branch, let's say that little circle branch sells a education course for 100 profit, and the 100 profit is taxed at the tax rate applicable to business operations in B, and that tax rate is my green figure of 30%. So I'm still back to my same scenario of 70, and the withholding, like in the United States, we have withholding on branch profits. So I want to distribute the 100 or the 70 after tax back to Acme, the head office, and then I have to pay a 25%. But if my branch office was owned by Beta or belonged to Beta, there would be withholding tax on the just, in fact, it would be the same book, the same tax book. So branch office would just reflect in the books of Beta. There would certainly be no 25% withholding. So that's kind of discriminatory. Now, second type of the inverse of that situation are countries that tax their locals but don't tax foreigners. Those are companies that offer tax incentives that discriminate against the local people. Tax treaties don't really deal with that situation. That's a totally different situation. That's usually dealt with in offshore financial centers, the spring class. And both the OECD and the European Union have been addressing that for the last 8 years through the business conduct. They call it unfair tax incentives, unfair taxation, or tax relief to encourage direct investment. With my branch office, A and B are sitting at the table, and B says to A, well, we want to encourage 8 countries to invest in B, just like we want you to encourage B companies to invest in A. We think that the integration of our 2 economies is a good thing, France and Germany after the war. So we think the integration is a very good thing from a political and from a economic perspective. The B says, well, normally we tax any business operations in B at 30%. However, we're willing to give up our jurisdiction to tax some forms of business operations that will allow your companies of country A, like Acme, to, by example, investigate the marketplace and to provide services to potential investments that they have in our marketplace. This is country B's marketplace. There are certain types of business operations that we both accept are business operations and that we could allocate or could produce profits and income, but we're willing, country B is willing to ignore the taxation of those operations if country A is also willing. When it's a country B company investing in country A, if country A is willing to ignore those business operations. And this becomes Article 5, the definition of the permanent establishment. And it leads to Article 7, the jurisdiction, the fiscal jurisdiction of the federal government of country B to levy tax on the office operations, the branch office of Acme, under its jurisdiction. So country B, and obviously we haven't studied Article 5 yet, but I'm sure everybody's gone through the OECD model. So I click on Article 5, and we see that country A and country B, now let me take a step backwards. I'm using this in the reference of a bilateral negotiation, but the OECD model, as we said last week, is a result of a multilateral of all the OECD members, so all the OECD members, plus commentary I showed you last week and the week before, the commentary where non-OECD observers such as India, China, Brazil, either agreed with or not objected to the article as it's written for the geopolitical multilateral world, but even the OECD members made observations that pursuant to their economic system or their tax system, sorry, timed out, made observations that according to their own system, that article would, in their negotiations at the table, they would approach that negotiation from a slightly different perspective than the commentary. Let me repeat that. Geopolitically, the nations of the OECD have come together and agreed in general that when they come to the bargaining table, because the OECD model has no legal effect, it's just a harmonization tool for tax treaties, and in particular for tax treaties amongst OECD nations. Has some impact, whether jurisprudentially brought in through the court system or referentially, persuasively brought in via revenue orders or revenue interpretations of their rules, or the court has stated it has persuasive yet not legal authority. So the OECD model by itself has no legal authority. It is a negotiation document that has been commonly agreed as perspectives of negotiation at a table between two bilateral, or you could have multilateral parties, but the document itself was unanimously agreed by all the member states. However, because each member state has a slightly different economic and slightly different tax system, they've made observations to each article that state things like, we agree with this article in the context of the geopolitical unanimity that we seek for harmonization of the application of tax treaties to promote trade, economic integration, blah, blah, blah. However, for our situation, instead of 5%, we choose 10. Or for our situation, dividends also means X. Or dividends does not also mean X. What have you. But those, to be clear, are negotiation stances. That doesn't mean that the country that's made this observation will get to contract, will have that observation be the outcome of its negotiation with the other country. By example, easy example, the U.S. has its own model, which is very similar to the OECD. It's just rather than the U.S. putting these long observations in the OECD model, because of our unique complex tax system, which constantly changes, it has its own model, which is the OECD with all those observations just stuck into the model itself, with Treasury commentary, explanation, explaining the real differences between the OECD model and the U.S. without direct reference to saying it's the OECD model, more, this is the way the U.S. tax system works. These are all negotiation stances, though. The U.S. has a limitation of benefits clause that'll be studied in this course later by Mike Rinaldi. However, that clause looks different in all of its treaties. So Holland negotiated that clause. The U.S. won't do a treaty if it doesn't get the clause. But the wording of the clause, what the clause applies to, definitions in the clause, all that's open for negotiation. Holland got one type of clause, Belgium got another, Malta just did a treaty with the U.S., they got a different type of clause, and so on. So all the different, now I got to look at the actual bilateral treaty between the U.S. and the other nation to see what the outcome of the negotiation was. But the OECD model is very helpful to study because it allows us to have a general harmonized approach to the treaty. And I know I'm ignoring the United Nations model right now, and there are other models out there which are less relevant for us, like there is a Nordic model for the Nordic countries. It's not relevant for our purposes here today. Marshall Langer likes to talk about those. So for country A and B in this negotiation of fiscal jurisdiction over our branch office, they've negotiated. Let's say that the OECD just happens to be there. They just adopted it as part of the negotiation. They said, let's make life simple. We're both OECD members. Or they say, let's make life simple. Neither of us is an OECD member. Both of us want to encourage OECD investment, investment from OECD countries. OECD countries understand the OECD model. And so let's adopt this between us to show that we're uniform, our rules are uniform, at least our international relations from the tax perspective are uniform to the OECD members. Whatever their motivations are, they've adopted Article 5 of the OECD model as their model, as their actual article in their tax treaty between A and B at the negotiation table, and they both shake hands and agree. Now, this Article 5 permanent establishment that you're staring at in front of the screen, but for my little writing above it, B and A have agreed that the term permanent, and we're not talking about the definition of permanent establishment today. That's two totally different lectures that come up in about 2 weeks, 3 weeks. No, in 2 weeks. It includes a place of management, a branch office, and so forth. So, well, a branch office, I'm telling you that my little circle is a branch office of Acme. And if we cut forward to Article 7, we would see that Article 7 says that country B is allowed to impose its normal tax on business profits to something that's considered a permanent establishment. So, what have I achieved in terms of fiscal jurisdiction and the alleviation of double taxation? Well, in this article, paragraph 4, and I'll circle that just so we're all on the same page. The term permanent establishment shall be deemed not to include. So even though above I've said a permanent establishment is, then I get to paragraph 4, and I say regardless of what I've said above in 2, it is not, and then I go to A through F. So country B says to country A, we will not levy business profits tax upon your branch office in the following circumstances, when your branch office is the maintenance of stock and goods, so merchandising, belonging, and then you read the rest of them on your own, and we'll study them in 2 weeks. But call it the two big issues that A through F cover for what permanent establishment is deemed not to include are when the branch office is doing market support for the trade in goods, or when the branch office is doing investment support for capital or loan investments, more financial investments of A into B. And so the branch office will not be taxable. You don't get into the issues of should we be allocating income and so forth to the branch office. It's not subject to tax by B. In true legal terminology, B is giving up its right to impose taxation. It's giving up its fiscal jurisdiction over the business income generated by this branch office of Acme in these following A through F circumstances. And another way to look at that, which is it's a different perspective. It gets you to the same outcome, but it's a different perspective. And I usually, for purposes of this class, I just teach perspectives. And I actually agree with this second perspective I'm going to give you right now. I agree with this perspective, but there's good arguments for whatever legal theory you come at this from. It's the same outcome. B is not giving up its fiscal jurisdiction over the rights of taxation of the head office of Acme. Instead, the treaty, the international agreement between A and B, suppresses, overlays, it suppresses the rights of B to collect the tax on the business profits. So you see the two differences. The first perspective is B gives up its fiscal jurisdiction to levy the tax. The second perspective is B doesn't give up its fiscal jurisdiction to levy the tax. However, the treaty suppresses the right of it to collect the tax. And again, it's the same outcome. So B is not collecting the tax. The head office isn't paying any tax to B, A through F situation. If it is not an A through F situation, and B is thus allowed, pursuant to their negotiation, which produced this treaty article, to levy tax, and or, from the second perspective, to collect the tax, then, and I'll tell you why I support B, by the way, why I support the second perspective. And I guess which perspective applies really depends on the country. If head office is required to file a tax return, and the tax return calculates the earnings and profits of the head office, and then but then it takes a treaty position, sorry B, you're not allowed to collect this amount, then I say the second perspective works. I mean, that's the what's happening is the second perspective. But if in country B the head office doesn't even have to file a return, it just marks I'm a PE, but I fall under the exceptions of paragraph 4, and it doesn't have to file an earnings and profits. Well, then the first perspective is the situation of B. And it used to be that most countries were like the first perspective, and now a lot of countries are becoming like the second perspective. Part of it is for to make sure for tax avoidance reasons, and part of it's for economic census bureau reasons. They need to collect more economic data on their own domestic economy, and that includes also direct investments, foreign FDI direct investments. We looked at the Bank of International Settlements last week. They need to collect more data internally so that they can manage their national accounts better, because the world is so integrated, and the impact of investments is just a lot more stronger on GDPs and revenue collections and national accounts and so on. So if country B is allowed to impose and or collect tax on the head office, then we'll get to another article, 23, which says that country A must give a tax credit. Now, country A may already domestically give a tax credit, and those tax credits and how all that works is going to be covered extensively in your lectures for for modules 10, 11, and 12 in international tax class. And Jim Lavoigna and some other tax credit experts are going to come work you through a bunch of different formulations of tax credits, domestically and under treaty scenarios. So you can see the difference and you can work those. But Acme would have to pay tax in B for the head office under this scenario where B is allowed to collect tax. And but then Acme would, in its tax filing to country A, state that our head office in B paid tax. The tax treaty, Article 23, says you have to give us a tax credit, which may be a more favorable tax credit than under the than typically allowed. And this is our income tax return from B, or our tax certification letter from B, whatever the treaty requires procedurally. And so country A would, with its Acme, company A, in country A, would file its tax return and get a tax credit by filing this piece of paper from B. So in this example, it would be 30. Of 100 profit, they would get 30, and we haven't looked at withholding, if there's going to be a withholding tax yet. Country A and country B have to negotiate if there will be a withholding tax, and if there is a withholding tax, how much. If this branch office falls under A through F, we don't have to discuss holding tax because there's no earnings and profits. So thus, there's no profit income to levy tax upon. There's no distribution from B to A. If there is tax levied on the branch office of Acme, then we have to discuss whether there is a withholding tax imposed pursuant to the treaty. And the treaty alleviates the double taxation generally through stating that either 1, there can be no withholding tax, or 2, there can be a withholding tax, but the withholding tax is limited to an amount set by the treaty regardless of what domestic law says. Domestic law in this situation says that withholding tax is 25%. And the treaty may state either B gives up the right to levy withholding tax, or B does not give up the right to levy withholding tax, but the maximum amount of withholding allowed by the treaty is, by example, 5%. And so instead of 25%, only 5% is applied. Again, Article 23 would state that Acme will get a tax credit for the corporating tax and for the withholding tax paid to the foreign country, that is, country B, the source country. The second aspect of the treaty in alleviating double taxation is I have 2 directors. The 2 directors have a personal income tax. So I have personal income tax being levied on them. Let's say the personal income tax in B is 50%, 50%. And in country A, personal income tax is 30%. Well, Acme is going to have to, let's assume our directors do not want to live in country B unless their income, their after tax, their in their pocket income is higher than it would be in country A, because they're being displaced, their kids are in school. A lot of people think, like, I live in America, but I have a chance to go live in France. That's very exciting. I can't wait to go do it. But a lot of other people say, while it would be interesting to go live in France, my kids are in school in America. Now I'm going to have to pay for an international English school, which is going to be even more expensive than the public or private school or parochial school, Catholic school that they're in the United States. my cost of living, let's say I'm living in Bentonville, Arkansas, and my cost of living is X, and my cost of living in Paris is going to be 10x. Right? It's just so much more expensive. And now I got to take French classes and yada yada yada. My God, it's all the French taxation is going to be higher than in America, and I have wealth tax and blah blah blah. There's no chance I'm going over there. So the tax treaty again will, and we're not going to go look at the article, but it'll state when country B may levy tax on the director and when it may not. So one of our directors, we said, is going back and forward. And the treaty, in that case, through the negotiation of the two countries, will state, like, for the guy going back and forward because he isn't there enough days, or because he's not paid by head office, he's actually paid by Acme, he's living in an apartment in B. But in that circumstance, we're not going to levy income tax on that director. He's more of a watching director, or he's an information collecting director, or what have you. But the other director, now he lives full time in B, and he's paid by the head office. He's paid by not the head office. He's paid by the branch office in B, and so they negotiate. And their treaty article says you're allowed to tax that director, and he's going to have to pay 50% tax. And so Acme's going to have to jack his income so that he has the same standard of living as he would in country A. That's going to be pretty expensive and add to the costs of the operation. But that's fair, because Beta, the domestic B company that Acme's invested in, it has to pay its people enough to make them interested to work there, so Acme's not really worse off. It's really paying its director, the second director, just like Beta has to pay its people. It has to pay perhaps a little bit more, Acme does, because of the risk factor. But this is more the expatriate factor of being uprooted and forced to live, even though it might be a nicer jurisdiction to live in, nicer weather, or what have you. There's other concerns, usually family concerns, of not wanting to necessarily just pick up your bags and go relocate for 2 years. And okay, so and then the treaty lets the directors, maybe the director likes it so much he wants to retire in country B. He ends up running the branch office for 20 years. He retires in country B, and now he has pension funds coming from A to B. And how are those going to be taxed and so on? The treaty sorts all this out. At least in theory, it sorts it all out through the articles. And so from the architecture of our treaty, we see Article 18 on pensions, by example. We see Article 16 on directors' fees. We have Article 15 on income from employment, or maybe the employees fall under Article 14, independent personal services. We have government service, students, and so forth as you read down your list. So our employees, they're not students. This is an education company. They're managers or they're instructors, something like that, administration. And Acme's not a government company. It's a for-profit company, we said last week. It has shareholders all throughout the world, in fact, fragmented shareholder ownership. From country A, from country B, from other countries. Now, let's move on to Acme's investment in Beta. We have the 10% ownership of shares in Beta. And let's say that Beta has a profit, an earnings and profit of 100 at the end of the year, and the board of Beta votes to distribute. They reserve half of the 100 in for reserves to meet growing costs. And the other half, 50, they distribute. And all the shares are equal shares. There's no preference shares here or anything like that for the moment. So Acme gets a distribution of 10% of 50, 5. So 5 dividend goes from Beta to Acme. 25% withholding on 5 dividend is 1, so Acme receives 4. Now, in this situation of the treaty, Article 10, the model says, and they've agreed the model says, if Acme holds directly at least 25% of the capital of the company paying the dividend, the maximum withholding rate is 5%. That's under paragraph 2A. So under paragraph 2A, we see 5%. But Acme only holds 10% of Beta. So paragraph B says, in all other cases, 15% of the gross amount of the dividend is allowed to be withheld by country B. Now, we, in this course, will look very close, drill down on several definitions. One, we've already opened the discussion of what is a withholding tax anyway. The Brazil example, is it a withholding tax for our technical fund for the royalty payments? And if it's not a withholding tax, then this article doesn't apply. Number 2, if it's not a tax, this article doesn't apply. Number 2, what is a dividend? Because Beta, we still have to address, is paying $1 million on the $10 million loan, but it's not a loan, it's some kind of share instrument or debt instrument or financial instrument, and that financial instrument entitles Acme to an opportunity for conversion in Beta in 5 years. Maybe some countries characterize that as a dividend payment. I can play with the financial instrument. I'm not a financial instrument guy, but actually we have, I think we're going to have somebody from the IRS teaching financial instruments starting in spring. And but certainly I had colleagues, their whole day was spent with like profit bonds, profit share bonds. And the profit share bonds were, instead of Acme paying 10% guaranteed $1 million on $10 million each year, Acme pays 10% of its earnings and profits, which sounds like a share then, or a guaranteed amount of $500,000 a year, whichever is higher. It could be an instrument like that. And all of a sudden we get into the gray area of what is a dividend and what is interest. What is equity? What is debt? What is a share? What is a bond? And the treaty will help us to define what falls under the word characterization of dividend. Because this article only applies in a dividend situation. There's another article that applies under an interest situation. There's a question. Petrus, a tax treaty is like a contract between countries that binds countries' businesses and citizens for mainly in business and all pros for the countries. Professionals for the countries, I assume. For mainly businesses and all the pros for the countries. A tax treaty is certainly like a contract, an agreement between two countries. The Module 1, Module 2 are all about how the tax treaty, and I'm not covering it because it's obviously covered in the materials, and you can further address these questions in the discussion forum asynchronously with Professor Alan DeCoker, but the modules are based on, the first two are about how that agreement becomes law in the domestic jurisdiction and how that law impacts other laws. Quick example, some countries, for a treaty to take effect, let's look at the United States. President signs a treaty, but it's not law yet. It has to be voted on by the Senate, and the United States Senate must, in voting that treaty, it must it must accept the treaty into U.S. law, but then the treaty literally just becomes another U.S. law on the books. And if the Senate and President agree a new law tomorrow after they've voted in this law and the President signed it yesterday, the new law is the law of the land as opposed to the treaty, which was the law yesterday. That's very strange for many countries in the world that the U.S. does that. Other countries, they don't even need parliamentary approval. The leader, the prime minister, the president signs the treaty, and the treaty is now law of the land. And the treaty between the two nations suppresses any domestic law made before or after that treaty was entered into force, until one of the countries says, this treaty no longer applies to us. And usually the treaties have a workout clause. They have once one country says the treaty don't apply to us, the treaty stops having effect after 6 months or some time frame, so that businesses can readjust their planning. Then, okay, so you have the scenario of how does it become law? Does it require a parliamentary vote or not? And when it does become law, does it become just under law in the books? Or does it become a super law, a supranational law, something that suppresses all the domestic law? And the materials look at this both academically and practically, and they look at this from textual treatise viewpoints of commentators, as well as from case law, from jurisprudence in different jurisdictions. And then the materials, more importantly, I guess, look at how courts apply treaty law in relation to the domestic law, and which wins out. Okay, Mark, thanks. And we'll record the rest of this. It is being recorded. It'll be up on the site tomorrow. And if you missed previous lectures, but you didn't, they're up on the site under links. Okay, so for Acme and its investment in Beta, the 25% withholding rate for at least the dividend coming from Beta to Acme, whatever dividend means, whether it means just the distribution 5, or whether it includes the interest payment, because B characterizes that interest payment really as a dividend under B's local rules. And this Article 10 then, as agreed between A and B, only allows either under paragraph 2, worst case scenario B, 15%, best case scenario A, 5%. And B may characterize the interest as, or what I'm calling interest, as a dividend, but it may not characterize the instrument as equity. So then beta withholds at the 15% amount under little paragraph B of paragraph 2. And A, ACME, may argue to B's revenue authority, hey, how can you characterize that payment based on this financial instrument as a dividend? Because under our interest article, there'd be no withholding, which may be why it's structured like that. So if we go quickly, pop over to Article 11 there, and it says no withholding, by example. Let's just pretend it did, and then it says no withholding, and so ACME has purposely structured its investment this way, but then B pulls out of the hat, well, but it ain't interest, it's a dividend. Well, then ACME says, okay, if it's a dividend, then the instrument, which has this conversion amount up to 50%, well, then we own more than 10% of beta. If that's a dividend, we own 51% of beta, and thus we get the 5% rate. And then the revenue authority of B turns around and says, well, no, the instrument's not equity. The instrument's more like debt. And now you got your, issue, your problem. How can it be debt, says A, says ACME, if it pays a dividend? And now they got to go to court. They got to go to, they got to discuss the revenue authority, do the revenue procedures, and maybe if it's such a big deal and they can't come to agreement, then they go to a mutual agreement procedure under Article 25, Mutual Agreement Procedure. This is if they really just can't come together and they have this whole problem. Now, of course, ACME can go to court and B and seek a refund. We don't owe you withholding tax. Look at Article 11 that we agreed, and we agreed 0 instead of, by example, 10% withholding or something. We agreed 0. And B says, we respect the agreement, it's just you're characterizing it wrong. When you apply a treaty, for example, for reducing withholding rate, do you need a special procedure or a sort of notice to the domestic authorities? Yeah, okay. That's a great question, Miguel, because in the United States, the answer is clearly yes. We have forms when you take a treaty position of why, and who's taking the position, by the way? Beta. Beta is taking the position in the withholding scenario because Beta is the one who would not withhold. So Beta would file in the United States this form to cover itself of why it didn't withhold and why it has reasonable ground not to withhold. Not all countries do that. Certainly not all countries do that. Some countries, by example, require that for no withholding, that I'll just use my Acme and Beta example, the Beta would not withhold, and it would not have a treaty position form, but it would file a tax residency certificate for Acme, that Acme is resident of country A, that the treaty applies. We haven't talked about Article 3 and 4 yet. That's next week. But Article 1, 3, and 4. But shooting quickly to Article 1, the person's covered, the taxpayer's covered, applies to persons who are residents. And so then we got to go look at what is a resident. And we got to go look at what is a person. And so we'll find our person definition, Article 3. We'll find our resident definition, Article 4. And, of course, we have the tax, which was last week's discussion. That's Article 2. And so we're going to drill down on that next week. But so many countries used to just require the Beta file a residency it was called a residency certificate, at least colloquially, because I filed many of them or had them filed in foreign countries like Mauritius and India. So Beta would file with its return the residency certificate of why it didn't withhold to Acme. But it didn't necessarily, in those circumstances, have to file a treaty-based form. It just filed the residency certificate. Countries have now developed procedures, not all, but OECD countries had developed procedures for treaty positions. What is it in Mexico, since you're a Mexican attorney? In Mexico, you have a treaty position form, like in the United States, do you? That's a question to you, Miguel. Do you have a treaty position form? Do you have a treaty position form in Mexico? No. Okay. So, and Mexico is a member of the OECD. Not all countries do by any means. Generally speaking, if Beta, the payor, the domestic taxpayer, is not going to withhold or not going to pay a tax on behalf of a foreign taxpayer, generally a tax residency certificate is needed in all jurisdictions. Whether you have the second document, the treaty position, is another matter. The U.S. treaty position document is not a very thorough document, by the way. It's in any way you can go pull it up off the U.S. IRS website. Yeah, it's the residence form. Okay. And okay, I see you, Lewis. Yep. So, so the treaty articles, and where we're going to go next week with our treaty discussion, the treaty articles apply to first establish definitions, and this is the architecture of the treaty. So the architecture of the treaty is we first establish definitions. I'm going to erase all the stuff on the board, and we'll finish up our lecture with going back to our original point, our objective today. What is the architecture of our treaty? Yes. So the our first perspectives of our treaty are the definitional ones, and so we have to look at persons covered. And let me just open up the issues now that we'll be covering next week. Persons covered. Is a trust a person in France? Is a trust even a person in the United States? Is a pension fund a non-taxable pension fund a person? Is a REIT, real estate investment trust, a person? Is an LLC a person? Is a 3-year-old child a person in the context of the treaty? Maybe a person, taxpayer in the United States. Maybe not. What about overseas? What if the person just inherited, what if the 3-year-old, their parents die in a plane crash, and they got $100 million of assets in a foreign country? And so you got inheritance estate gift tax treaty, but let's say those investments pay dividends, interest, royalties, that kind of stuff. And is my 3-year-old covered? I'm just throwing out issues. Okay, so persons may seem kind of obvious. It's not. Government or government entities, persons, are non-taxable, tax-exempt charities, persons. So we got to look at that. And what is a company in one jurisdiction may be characterized as something else in another jurisdiction. Just like we looked at our dividends in last week, we looked at the word tax and what tax applies to. Okay. Number 2, taxes covered. So last week we looked at a variety of potential taxes, Social Security, wealth tax, yada yada. What about, and we also looked at federal versus state versus regional versus municipal. So United States tax treaties, by example, generally or always apply to the federal taxation. But do they apply to excise taxes or just to income taxes? Do they apply to the state of California or just to federal taxes? Do they apply to employment taxes like Social Security, Medicare, or just to personal income tax? So we got to look at Article 2 for that. These are the definitional articles. What does the word tax mean? And what taxes are covered? Number 3, we'll have our general definitions of the treaty. And number 4, finally, what is a resident? Because Article 1 says this treaty only covers residents. So if you don't follow in the definition of the word resident, i.e., if you don't follow the Article 4 definition, this treaty doesn't apply to you. You never start the process of going down the treaty analysis. And persons are covered by this treaty, but we got to look at our Article 3 definition of what a person is, which I was throwing open a bunch of issues for you before. So we pop open Article 3. We'll say a person includes an individual, company, and any other body of persons. So I'm not sure that helped me on the word trust or REIT, or maybe it did, maybe it didn't. And we'll go look at some commentary, but we'll go look at some treaties as examples. And then we get to Armed Establishment, which we just touched upon today. But that's then a different lecture that occurs the week after. After that, we get into the divvying up, the allocation of tax rights, whether you see it as an actual right of taxation or you see it as simply the suppression of the right of collection of taxation. Two different perspectives. And so we got our business profits, which we just did our ACME to branch off as example. And we go through dividends, capital gains, yada yada. And when we look at those, Mike Rinaldi is going to kick into the lectures, and that's in your syllabus, and you'll see what he's talking about. In both Tuesdays and Thursdays, both classes, tax treaties and international tax, we'll be going through those lectures. Then we're going to get to our Article 23 credit. And so again, it's going to be both Tuesdays and Thursdays tax credits. And we're going to look at calculating tax credits under domestic law, generally speaking, for countries. under treaties and so forth. And we'll also look at exemption. And then Marshall Langer is going to wrap things up from U.S. Thanksgiving time through December up until winter break, Hanukkah, Christmas, etc. On the remaining articles, such as mutual agreement, exchange of information, the newish assistance in the collection of taxes. I saw in my tax analyst news yesterday for tax treaties that New Zealand and Australia have just signed a protocol for their tax treaty for the assistance in the collection of taxes. And then of course we have to have our Article 29. What does the treaty apply to? Most people, even those people who are tax consultants in the United States, do not know that the United States is colonies, though many of them have been to conferences in Puerto Rico. Puerto Rico is not a state, so is Puerto Rico covered by the tax treaty? Is U.S. Virgin Islands? Is Guam? Washington, D.C. is not even a state. Is it covered by the tax treaty? What about the Northern Marinara Islands, Saipan, and so forth? Then, about England with its colonies, and Portugal with Madeira, and so on. Lots of countries have protectorates, colonies, overseas territories, commonwealths, whatever you call it. Does the treaty apply? Territorial extension, Article 29, and then 30 and 31. When does the treaty actually enter into force? And when one country calls it quits, when does it terminate? When does its application terminate after the date that one country calls it quits? Okay, that sums up my lecture on this week, which was part 2 of a 2-part series of last week saying these are how the problems come about, the double taxation problems, and part 2 was, and this is a general just overview of how the problems are resolved. And last year, because some of the students this year were here last year, you're going to notice I was teaching from a totally different perspective last year, because unfortunately not all the audio recorded on those. So what happens is next year you'll get it from that last year's perspective. I approach treaties, and for that part international taxation course, in totally different ways. And so for those of you who sat in last year's classes, you're going to notice that I am not covering it in the same way as this year. So you're not going to be bored. I have the recordings. The audio just doesn't come out, or it's so bad because we didn't have the newer recording technologies. So be it. And last year I taught with a lot of symbolic logic. So this year I'm not going to use my symbolic logic. Next year I'll use my symbolic logic again. If you like the symbolic logic, I can send you the lectures. They're just either the sound didn't come out or it's so bad that it's hard to listen to. Okay. That's it. So I'm just waiting. Are there any questions on today's lecture? The treaty form here is 8833. So okay, well the question really is, where do I find the forms? So, since I still got my screen showing, what I would do is, you can go to the IRS website clearly, and pull it off there. But I would go search, by example, either in B&A or in Checkpoint. So I'd go to my proxy server, I would pop open my research databases. I would go to my, I always prefer a B&A for first look. So I go to my B&A website. Miguel says he's having problems with posting on the forums in Twin. Is anyone else having the same problem? Remember, Miguel, to email the Twin support. And when you're in Twin, it'll be on the bottom left-hand side of your screen under your menu.
Sometimes it will not work. Try more times, it will work. Because Twin has technology problem to post on forums.
Yeah, so we're saying here that Twin has a problem with its postings. Email Twin and harass them. It's a new problem because they changed the look-see, the functionality of the forums, and I don't know why they changed it, because I like the old forums, such as life. It usually happens when someone else is posting. Anyway, email Twin. I'm sure they're aware of it. Regardless, the more emails they get, the more focused they'll be. So on your B&A, I'm just going down to pull open my tax management portfolios. Use the drop-off box. The drop box is for assignments to the professor.
Yes, different.
This is,
I think he means discussion forum.
Yeah, the discussion forum is, of course, where the give and take, the questions and answers are in the course. So I'm clicking on International Tax under my Tax and Accounting Center at B&A, which I access through my proxy server. You could have gone to Checkpoint, you could have gone to CCH, you could have gone to Lexis Westlaw, you could have gone to the IRS website. I just prefer looking at my B&A first. Now, look at I didn't just so happens. Look, current status, U.S. tax treaties and international tax agreements. From the editors, that little article down there, I'm circling it in orange. It's at the corner of my screen. It'll be on your screen in one moment. I see it at the under my B&A screen. I'm just waiting for it to appear on my student screen. It's about to appear on your screen now. Anyway, so then I'm going to go look at taxation of, I can look at, well, I got tax forms on the left-hand menu. You'll see that under the word tax forms. And I have in the center, foreign income portfolios. I have my taxation, I have my taxation of foreign, yada yada. So I'm going to taxation of foreign persons, U.S. income, or I think I could also choose provisions applicable to both U.S. and foreign persons. And I could go to source documents, I think, under the left-hand menu, and you'll see tax treaties. I don't usually use that. Now, I could get the same IRS agency documents that I can get under the IRS website here in B&A. I'm circling that in orange on the left-hand menu at the below, agency documents. And I'm going to, anyway, click on the taxation of foreign persons. And then I would start to go through my portfolios to see if not only do I find my form, which I will find, but the analysis of the form, the commentary on how to fill the form in, kind of like a workflow chart. Now, BNA doesn't have workflow charts built into it, but it'll get, it's close to it. And so now I'll find not only my form, but how to fill out my form. And by example, U.S. withholding and reporting requirements for payments of U.S. source income to foreign persons. And then I got my, and this is a very good, the reason I'm taking you through this is just to show you, I told you to read Fogel, but for those of you who are interested in some further U.S. research, but it applies internationally, theory of withholding. I'm pointing that out to you with an orange circle around it in case you can't see it on your screen. I assume everyone has followed exactly what I'm doing with my little research into BNA right here. And then who asked me the question? It was no, it was Susan. Okay, so no, Jacqueline. So we're okay. So then, Jacqueline. So now you're going to find your forms and so forth here under your referred to here under your BNA portfolio. So and of course, I'm going to want to look at the exact type of form. I mean, what type of income I'm discussing to make sure I have the right. Okay, so here's information returns relating to foreclosures and abandonment of security, to cash received in trade of business, 6050I, yada yada. So I'm going to have the ability here to not just find the correct form for the correct type of income, but also to again to get the commentary and the explanation. It doesn't mean that I don't have the same information and access under Checkpoint. So you do want to go look at Checkpoint if that's your favorite. You do want to go look at CCH if that's your preferred mechanism. I just particularly happen to like BNA in this circumstance. Jacqueline, thank you. Okay, I see that. Was there a... Okay, got it. Okay. So, let's see. Any other questions? I'll stop showing my screen. Close. See, Petra says no. Ken, no. Okay. So I'll make my final announcements to remind you what happens tomorrow. Tomorrow for AML class, everyone should come. And for the lecture from the Career Services AML lecture from Jason Simpson at Standard Chartered, who's an alumni hiring 10 to 15 persons for his department right now. Then secondly, everybody should be in the Career Services course already, because Hester gallantly stayed here late last night and entered everybody into Career Services. All alumni are invited to join Career Services too. We're not going to pre-enter you. If you're a student enrolled in the program, you're required to be there. You don't have to show up, but you're required to be in. The alumni, we're not going to stick you in there because you'll end up getting a lot of emails you may not want. But if you want to join, all you got to do is email Hester, and she'll guest you into the guest access you into the Career Services class. And in the Career Services class, you'll see it's a whole course. There's lectures, and there's the book I've written, and blah blah blah, all about Career Services. And we're going to have a series of lectures, like the guy from the IRS is going to be giving Career Services talk, working for the service and the different fields in the service, like. He comes from financial instruments, and then you got LMSB. and we have a student from LMSB, so a student can talk about his experiences working for the service, and then we'll have people working for companies, and I'll have Aaron will talk about, like, from the perspective of, he worked in a petroleum company, BP, and now works at Tyco, and we'll have, though she doesn't even know it yet, but we'll have Renee talk about, she's worked in the banking world and her experiences from a career service perspective, and so on. And then we'll invite, of course, the recruiters. The recruiters are going to come talk, and those are very interesting as sounding boards for your questions. How should my CV look? I spent the weekend working with Hillary Spilkin on her curriculum vitae, and as an example, so that I could use it as a case study of what it did look like, what it evolved to, and then finally, she, at the end of the day, even evolved it again, and it was even better than what I was suggesting. It all looked great, from a formatting, from an informational presentation, and the important part is that for every position she was applying for, at least every type of position, the CV was malleable and could change, and she dealt with some questions that there are hard questions to deal with, like, what'd you do the last 3 years, or how old are you, and things that you're not supposed to ask, but in practice, this is part of human relationships. People going to figure it out. So how do you deal with that? How do you address it? So she had to deal with that on her CV. And yada, yada. Okay. Show up tomorrow for that first career class. Correct, Susanna. It is called AML, and it is at 9 o'clock, and you will find it on the public calendar website. So that's the my.calendars.net/TJSL. And it says 9 o'clock. It is correct. It's 9 o'clock. That's the AML lecture. Then on Thursday, this afternoon, we have transfer pricing. For those of you in transfer pricing, remember, it's this afternoon in a few hours. It's morning for De Silva in New Zealand. It's tomorrow morning, Wednesday. Remember, look at your calendar for tomorrow, because we have 4 or 5 lectures tomorrow. I forget. I think it's 4 lectures tomorrow. And then on Thursday, we have 2 lectures, because I'm forgetting why, but I know that, no, it's a different day. Forget it. On Thursday, we have my lecture, and then on October 3rd, I'm being interviewed by Speaking of Taxes. That's it. I've posted that in Facebook and in but what I'm going to cover are the economics of the financial services industry. It's a career services thing. So you're going to be on that career services lecture. It's posted in the career services course. Okay, that's all the major announcements, at least that I can think of. Jason Simpson is also head of the Alumni Association this year, voted at the graduation last year. He's going to help organize the 10th anniversary graduation class anniversary. It's our 11th year in the United States, but our 10th graduation class for a 2-year program. So that's this year in May. We want to make it a big deal. We also have the new building going up. I'll keep talking about the new building because it's our $128 million achievement and $133 million I heard Rudy say before he left for Russia. So you'll see that building in action if you come in May for graduation or for the social events or the 10th year anniversary. And hopefully we'll have a big old conference call on for everybody who wants to participate, organized by Hester. Okay, I'm going to stop recording and